All right, let's begin the session. Thanks a lot for joining the session. Before I begin, let me do a quick check. Is my voice audible and clear? Clear, awesome. And let me also introduce you to my team so that we can move it forward. I'm Shekhar. I am part of Factor Lab team. I've co-founded Factor Lab, and we are a SEBI registered research analyst, and also distributors for PMS, AIF, SIF, and mutual funds, as well as gift city related products. And I also have Deepak along with me. So we'll be conducting this session. The reason for doing this session is that of late we have seen quite a good amount of interest in global investing, especially because the Indian markets are not moving anywhere; they're sideways, and at the same time, the foreign markets like the US, or for that matter, even the Taiwan, Japan, Korea, they are all doing really well in the emerging markets. So, naturally, there's quite a bit of interest from the investors because they would want to invest or identify these opportunities and invest in those opportunities. And unfortunately, there are very limited options for Indian investors to invest in the global market. So there is good interest, but the opportunities are less, and the markets are rising elsewhere, and the Indian markets are not doing well. So all these four have culminated into a peak in the interest, and that's the reason we see this space very ripe to be disrupted. And luckily, we have now good options coming up. So we wanted to touch base on those options which are available for Indian investors to invest abroad, and Gift City is one among them. So in this session, we'll be highlighting the what the Gift City is, what are the advantages of Gift City. We also would want to give you an overview of what kind of investment options are available that are available at this point of time, and we'll also be debunking some of the myths related to Gift City investing. So let's begin. I'll be sharing my screen and walking you through these slides. Again, let me know if you can see my screen. Yeah. Good. All right, so let's begin. Um, so if you notice, the reason for investing in the global markets comes from four reasons. Primarily, it is because of the diversification benefits that we Indian investors will get, that will reduce the dependency on single country or market. Secondly, by diversification, we will tend to mitigate the overall portfolio's volatility. And thirdly, we'll be getting access to some of the global leaders, let's say an Amazon or Apple, which are not available to invest, or maybe let's say Hermes. These are the stocks that we don't usually get to invest in the Indian market. And if someone were to get exposure to these, so in access to global markets is one of the reasons for investing abroad. And fourthly, we would also want to latch onto some growth opportunities. Let's say the latest AI trend, semiconductor trend, or some of these trends, you might not see direct beneficiaries in India. In fact, you might see these beneficiaries to be completely be based out of India. So how do you get exposure in that case? So these are the four major reasons for investing in abroad. I'll show a good example of this with the help of a chart. What do I mean by diversification and risk mitigation? So broadly, what we are trying to achieve is this. So take this as an example. Let's say we have two assets, asset one and asset two, which are moving in the respective fashion. I can't see this. Okay. Yes. So let's take this example that we have, let's say, two different asset classes, asset one and asset two, each moving in a particular direction. Now, both these assets are volatile in nature, equally volatile for that matter. But when you combine these two, the resultant portfolio will be much smoother. That is the key benefit of diversification. So we are trying to combine two volatile asset classes and get a portfolio or a resultant asset class or a combination which is less volatile. That is the pure reason for someone to invest or divest in other opportunities. Now, if we were to look at these, what is the pattern that we identify is when one of the asset class is going up, the other asset class is either sideways or downwards. Now, that is what we call as no correlation or negative correlation. A high correlation is if both the asset classes are moving in tandem together, then that is called as high correlation. Ideally, the reason for investing is to ensure that we have multiple asset classes in our portfolio whose correlations are either negative or in low single digits, low single positive digits. Now, going back to our slide. Now, these are the four major reasons why someone would invest globally. Now, also talked about diversification and correlation, right? Now, let's see what is the correlation amongst the different indices. So, there are a whole lot of indices that are available for someone to invest. But does the correlation, what we spoke about earlier, does it hold true? That are these indices genuinely uncorrelated or negatively correlated? To do that, we have done this exercise. What we have picked up is we have picked up four Indian indices: Nifty 50, Nifty Next 50, that is starting from 51st market cap to 100th market cap, Nifty Mid Cap 150, that is 101th stock to 250th stock in terms of market cap, and then Nifty Small Cap 250, that is 251st stock to 500th stock in terms of market cap. So we have covered four distinct market caps in India and have run a correlation. Also, along with that, we also did the correlation check with Nikkei 225, which is a Japan index, S&P 500, which is the US broad-based market cap index, NASDAQ 100, which is specifically within US only technology or consumer services index or innovation-led stocks which are available in NASDAQ 100. And then there is Hang Seng, which is a proxy for China or Hong Kong index. And then we have Euro Stocks 50, the top 50 free floating market cap wise stocks of the Euro region, and then gold. Now, when we ran the correlation matrix across all these indices for the last 20 to 25 years, what we have noticed is that there are three distinct patches or groupings that we can visibly see. One distinct group is this dark red. These are nothing but the Indian equity markets. So just by diversifying within the Indian market space by spreading across large cap, mid cap, small cap, doesn't necessarily mean that we are actually diversifying. In fact, the correlations are pretty high, around more than 0.8, 0.9, 0.95. So most of them go or move hand in hand together. So if there's a crash happening, they'll all fall together. If there's a rally, all rally together. So we actually are not getting the benefit of diversification by investing only in the Indian market cap indices. Then the second patch or distinct green color that we see is of gold. Gold, if you notice, is completely uncorrelated or negatively correlated with all the other equity asset class. The way to read this chart is the correlations usually lie between -1 to +1. -1 being negatively correlated, meaning both the any of the two stocks or indices are moving in opposite direction. If they are positively correlated and having a correlation of +1, meaning they both are moving in the same fashion. If the correlation is close to zero or -0.1 to +0.1, it usually means that these two indices or asset classes are uncorrelated. They both have independent paths. So the ones that we are actually interested are where we see negative correlation or no correlation. If it is positive correlation, we have highlighted them by displaying it in red, a negative correlation in dark green, and any other color in between the light colors are uncorrelated ones. So you see that the need for gold, irrespective of what equity index any investor would hold in, not just in India, any investor in US or Europe or Japan, etc., always having gold is a good diversifier to the overall portfolio that we already must be knowing by this point of time. Especially in the last 1.5 year, we have seen a significant gold rally during the period where the Indian equities were not doing much, and also post COVID. Also, we have seen how gold has helped in one's portfolio. Even if you go before during the GFC global financial crisis, also we have seen how gold's role has been helping in terms of being a good diversifier away from the equities and helping the overall portfolio's volatility. Now, this is the second patch that I'm referring to. Having gold exposure is a must because it is like an insurance that you pay to protect your portfolio in the bad situations. The third patch that, or the third grouping that I would want to focus are the ones where you see the light green colors, where the correlations are between zero point 0.3 to zero point 0.4. These are ideally where there is not much of correlation. At the same time, we don't say that they're completely uncorrelated. There is some correlation, but not significant enough as compared to the previous other groupings. So an example could be the S&P 500 with the Nifty Small Cap 250, 0.38, Nikkei 225 with Nifty Small Cap 250, 0.38, Nasdaq 100 with Nifty Small Cap 250, 0.35, or for the matter, Euro stocks or Hang Seng. They're all in the range of 0.3 to zero point 0.4. Now, one more observation that we need to see is that even among the different market caps of India, the small caps are even more uncorrelated with the other global indices, primarily because these small cap stocks are mostly inward domestic facing organizations or companies, whereas the large cap and mid cap stocks are dependent on exports and have a good linkage with the global diversified economy, and hence have a higher correlation with the other asset classes or global asset classes. A small cap has a very less correlation amongst the global asset classes. Now, what we have seen earlier is a point in time. Let's say we have taken a correlation over last 20, 25 years and shown this data. But if, let's say, we were to see a rolling 1 year correlation, then how would it be? So this is this chart. I'll try to break this chart into an easy, understandable format. Suddenly, by looking at it, it might look cluttered. But if you notice, what we have done here is we have plotted the correlations, that is -1 to +1, over a period of time, and we have taken every 1 year rolling correlation against Nifty 50. So same thing, you can notice three distinct groupings. This is one grouping, this is second grouping, and this is the last or third grouping. This grouping is with respect to Indian market cap indices, the light pink to dark pink. They're all in the high elevated levels, around 0.8 to 1, meaning high correlation with the Nifty 50. Then there are the international indices, which are anywhere between 0.2 to 0.6. And they tend to change for a period of time, but broadly, they stay in the range of 0.2 to 0.6. Of late, one important notice is that the Hang Seng or the Chinese index has been negative, showing negative correlation or moving away from the regular correlation of 0.6, and is genuinely diversifying away from the Indian markets. So this is the second grouping, which is unique and often offers a diverse uh, opportunity for the Indian investors. And the last grouping is the gold, which moves anywhere between -0.4 to zero point 0.2, often averaging at -0.1 level. So it is completely uncorrelated. So having uh, allocation in each of these grouping is a good way to reduce the overall risk. This is also a similar way of representing the data, but what we have done is we have done a clustering of the different indices and try to show how are different indices closely associated with each other. So, in a better way to understand is that each bubble represents a particular index, and the stronger the line joining them means the tighter they are coupled with each other, If there are no lines, this means that they're completely independent and are not actually clustered with these indices. So this way, we'll be able to identify which indices are genuinely diversifiers. So again, we see the same pattern that the Nifty, mid cap, large cap, small cap, even the S&P 500 are largely correlated together. The exceptions being the Nasdaq, Hang Seng, Euro, and gold. So this is at a broader level the need for diversification. Now, I'll also bring down a point which Deepak will be sharing about why is the need even more important now.
Okay. So I think up until this point, Shekhar was talking about why is it important to have certain part of your portfolio allocated towards global assets. I want to briefly, very quickly talk about why is it even more important now in the times that we are living now. From the time the Russia-Ukraine war started, and then followed by the tariff wars, and then now we are witnessing the war between Iran, US, and Israel, right? So when such geopolitical risks happen, how does Indian markets react, right? So this is what you're seeing is a very popular research paper on Elsevier, and this alludes to the point that when such geopolitical events happen, capital shifts from emerging markets to safer, mature markets, right? And that's the reason you are seeing a lot of capital. Just in March, more than 1.54 lakh crores have been moved away from Indian markets by FIIs, right? So this is one part of the research, which essentially says that capital moves away from emerging markets. Now, you might ask a question that, is the current war really a geopolitical risk for India? Right. So first, to establish that, we're looking at an index called Geopolitical Risk Index. So as you can see on the screen, this is an index developed by Matteo and Dario, and this is index that is displayed in many research papers. And I've used this data to create a visual to understand, is the current geopolitical event that we are seeing a risk really, right? And you can see here that, if you look at the last 6 years of data, and the average, long run average of the geopolitical risk index is 103. And if you add one standard deviation to that, it is 152. And two standard deviations is about 200. Now, if you see in just in March 2026, you see the geopolitical risk index stands at 297. So that means it's beyond two standard deviations. So clearly indicating that what we are seeing today is a major geopolitical risk according to this index, right? So now we've talked about whether these events impact emerging economies or not. Yes, it does. Then we talked about whether this is really a geopolitical risk or not. Yes, it is. Now we will talk about what happens to India, right? So we talked about emerging markets as a whole, but what happens to India is clearly defined in another research paper. And this is research done between 1990s to 2025, as recent as 2025. Let me just indicate. So 1990 to almost 2025. And this, the broader abstract from this paper is that, these global GPR shocks induce significant negative responses in most broad market indices, right? So this is a research done specifically on Indian stock markets. And this is even more clear when you see the graphs. And I'll show you Nifty 50. How does it react to a geopolitical peak like what you're seeing now. So if you see almost, after even after like 1 year to 2 years of time, the index is still recovering after a geopolitical event occurs, right? And this actually is a broad way of looking at it. There is also a very clear graph on how when different countries engage in war, how does India react to it? And very interestingly, when India itself is engaged in war, you see that it actually very quickly recovers after it drops. This is Nifty 50 recovering over this. The x-axis is the number of months, right? So as you can see, within 1 to 2 years, it is kind of recovering. But when countries like US and Saudi Arabia are involved, you can clearly see that even after a year or two, it is still under or even negative in some cases, and correcting, right? So markets are still correcting even after long periods of time. So so basically, what I'm trying to share with you all is that um, one is that the asset allocation is towards global markets is important, some part of your portfolio. And then when events like this happen, Indian markets are too sensitive to such geopolitical shocks, and that makes it even more relevant and even more important for Indian investors to look beyond Indian markets to diversify their portfolios, right? So with that, I'll uh, give it back to Shekhar, who will now talk about, okay, how do we actually participate in these broader global markets, and what are the different opportunities or ways to do that?
All right. So I think since these events which have been happening of late are not directly impacting us, so it might look that everything is fine. Unlike the COVID, where we were in a different difficult situation, we were facing actually these at first hand. So we got to experience the turmoil firsthand. Even in the case of Ukraine, we were not direct party involvement, and even the war was happening for us, it was just status quo. So actually, that didn't matter. But now the this war, even though we are not part of it or nothing is impacting us physically, but the shocks of the oil and the consistent rise in the Brent crude will slowly percolate into inflation. And also, we are seeing the risk in terms of the US bonds and the Indian Treasury 10-year bonds. Okay, so keeping aside, I'll just what I'll do is I'll show you the options that are available for someone to invest in the foreign markets. Right now, there are three options which are available for the Indian retailers. One is through mutual funds. There are a good number of mutual funds which are already investing in the specific themes across the globe, from US, Brazil, Europe, China, Korea, Hong Kong, Japan, Southeast Asian markets, even in Singapore REITs. There are a whole lot of opportunities to invest in mutual funds. In fact, some of the flexi cap funds also were investing in foreign markets. For example, Parag Parikh or DSP Value, Motilal Oswal, they're already investing. But something had changed in the year 2022. The RBI put a limit on the number of dollars that an AMC can invest abroad. They capped it to, I think, $1 billion. So because of that, most of the AMCs were quickly breaching those limits. And whenever those limits come down, either because the external market caps go down, or if there's any redemption, only because of that, usually the caps come down, and then they're again allowed to invest. But the monthly SIPs coming in, the values are only going to go up. So it becomes very difficult to go below that $1 billion level for any of these AMCs. And you might have seen a recent example. Let's say the Nippon has launched or relaunched Taiwan and Japan fund, Nippon Taiwan and Nippon Japan fund, and these markets were growing very at a very rapid pace. So within a week or so, they had to close it again because they've breached their limits. So mutual funds are an easiest way of to invest, but the challenge is from the limitations that one can invest. And even if one were to invest in the amounts, we are not sure when can we invest, and if we start to invest, when will the limits be breached. So to build a meaningful position in the global markets through mutual funds has become a difficult proposition. Only a token amount can be invested just for the namesake, but not actual a meaningful allocation. Now let's come to the other option, that is through direct investing. I'll touch upon gift at the last. I'll come back. I'll come to the direct brokerages that one can invest through. You can invest through interactive brokers, Ind Money, Vested. Now Ticker Tape is also allowing. So I'm clubbing all them as international brokers for simplicity's sake. Investing through international brokers is the simplest form. You, in terms of you opening the account and investing, all that is a breeze, not much of complication in terms of investing per se. But the challenges are manifold in other segments. Namely, first, in identifying what stocks, which ETFs, when do you rebalance, when do you exit, when do you double down, all this becomes a difficult task, because earlier in mutual funds you were leaving that task to a fund manager, and it was their headache or responsibility to actively manage the funds. Now it becomes the responsibility of the individual. Already, let's say you are managing an Indian portfolio. Now you also have to manage your external portfolio. So that's the challenge that we see in the direct investing. Let's assume that you've overcome that challenge. You have a good philosophy, or you have a good strategy on investing the stocks. Then comes the next challenge, which is how do you invest? Or you obviously have to invest by converting from the INR to the USD, and that brings the challenge of what is the conversion rate that you're going to get. So the conversion rate usually depends on the size or the quantum of the investments that you can make. So let's say a bigger retail, a bigger fund house can have a good negotiation compared to an individual retailer who is investing, let's say maybe a lakh or 2 lakhs or so. So that's the challenge of INR conversion. The third challenge is in terms of LRS. Up to 10 lakhs of rupees, you can invest through the LRS schemes. Nothing, there's no TCS allowed. But if you are investing more than 10 lakhs in any financial year, then 20% is withheld as TCS, tax collected at source. It is not a sunk cost. The money will be refunded back while you file the tax returns, or adjusted during the tax returns, but that is blocked for the first for the 20% above the 10 lakhs. I think that gets applied even in gift also, but that is not there in mutual funds. So that is the third challenge. Now fourth challenge is when you start to get returns, meaning let's say when you start to exit some of the stocks, or you start to get dividends, that is where the real problem actually is. So whenever you sell any international asset, you are liable to short-term capital gains or long-term capital gains based on the number of months of holding. If it is less than 24 months, it is short-term capital gains. If it is greater than 24 months, it is long-term capital gains. Short-term capital gains is 20% plus the surcharges or the income tax slab rate that you actually fall under. And if it is greater than 24 months, it is the 12.5%. If it is less than 24 months, it is at your income tax slab rate. Apart from the 12.5% or the income tax slab rate, there are also cess and other charges that are also collected. The other challenge is of the dividends. Every dividend that you receive, let's say you invested in a stock of Nvidia or Apple, these dividends that you get 20% or 25% actually is withheld by US on the dividends uh, declared by the, let's say I'm talking about the US market. If they declare any dividends, any stock, then 20% or 25% is withheld by US. And on the remaining amount, you again have to pay the dividend tax based on the Indian laws. Now, the amount that you've paid or which is withheld in the respective jurisdiction, you can always claim that tax, that this, if at all India and that country have a double taxation avoidance agreement treaty, then you can always claim the tax credit from the broker and submit it to the income tax department and can get the dividend that is withheld. So roughly in and all, there are around four declarations that you need to make with respect to the foreign investing. I'll just quickly show what are those four. So these are the important tax return filing disclosures that you need to keep in mind. One is Schedule FA, that is foreign assets that you are holding. Second is Schedule FSI, what is a foreign source of income that you're getting whenever you make any tax claims. And Schedule TR for tax relief, and also Form 67 for FTC claim, that is the dividends. Now, if at all we do not disclose any of this, then unnecessary tax complications might arise. So it is always better to have these in hand ready. Now, this brings us back to the question, like in terms of the ease of investing, in terms of the direct retail broking is a bit difficult. Then comes the final and most challenging uh, option in the direct broker investing is the estate tax. Now, estate tax is whenever something, God forbid, any death happens for the investor, then what happens is that the US government is going to charge 18% on the income, and they'll only pass on the remaining 82%. Now, for that is for the residents of the US. Now, if let's say if the NRIs or Indians who are investing abroad, for us it would be close to 40 to 50% is withheld as the estate tax. Now that is above $60,000 or above. Let's say when the death occurs, or when something untoward happens, and at that point of time, if your portfolio is 60,000 USD or more, then you actually would be getting much lower value than the actual value because of the estate tax. That is the major challenge with respect to investing in the direct sense. Now, given this context, let me now talk about what are the options that are available in the gift. Now, with respect to gift, first thing, it is as easy as a mutual fund. You can invest by opening a folio and investing it. You can convert your INR to USD and invest in it. But the minimum ticket size is $5,000. Unlike mutual funds, where we can take exposure with as low as 500 rupees or 100 rupees, but in here, the minimum ticket size is $5,000. And there's no estate tax. So whatever money that you invest, you can fully redeem in case of any eventuality of death. And thirdly, the whatever taxes that are there, you don't have to, or the individual investor doesn't have to pay. It is all borne by the scheme or fund itself. The NAV that they share, or the NAV that we see, is post taxes. So when you redeem the fund, you don't have to pay any other additional tax, and you get what you see. That is because the scheme is paying all the taxes at their PAN level, because this is a trust that is investing. So when the trust is investing on behalf, let's say in the US or Europe, in the whatever markets, all the taxations, all the long-term capital gains, all the short-term capital gains, the dividend tax, brokerages, etc., are already paid by them. Now, the question comes is, at what rates are they paying the tax? Since they are an entity or a fund house, they will be paying they will be paying the taxes at the highest income tax slab rate. So, for example, the highest income tax slab rate is 30% and above. So what happens is the short-term capital gains will become 42% by default, and long-term capital gains becomes 12.5% plus is roughly around 14.5%. So you'll be seeing two NAVs for a retail fund, and one NAV is a long-term capital NAV, and the second NAV is short-term capital NAV. So based on your tenure, you will, when you, let's say, withdraw, if your tenure is 1 year and 6 months, you would be receiving as per the short-term capital gain NAV and getting the amount. If you are staying for, let's say, more than 2 years, you would be getting your NAV as per the long-term capital gain. So that those are the broad landscape of investing globally. Now, to quickly understand a framework of what is better in which scenario, we have created this simple framework or heuristic. If your investment amount is small, which is less than 10 lakhs, and you don't see a scope that you would want to invest beyond this, not just now, in future also, then obviously mutual funds are a better way to invest. And if you think that the investment option or the investment amount over a period of time will increase between 10 to 25 lakhs or more, then gift retail would be a better option. And if you feel that the the convenience, or you want the complete control of all the investing, and you feel that you can be a better judge in terms of the investment decisions, then taking a direct option is better. So this is a quick heuristic or a framework to identify which investment approach is a right option. Now that I've given you a overall overview of the Gift City, now let me double click and present you the options that are there within the Gift City as of today. We are recording this video on the 1st of May 2026. Through Gift City, there are only 4 retail funds which are available for the Indian citizens to invest abroad. The first is Parag Parikh, second is DSP, third is Marcellus, and fourth is Edelweiss. And each has its own distinct element. The Parag Parikh is offering a plain vanilla index options, that is index strategies. That is, you can invest either in a Nasdaq 100 fund of fund, or you can invest in a S&P 500 fund of fund. These are managed by Invesco. So Parag Parikh collects the money and simply invests in Invesco Nasdaq 100 fund or Invesco S&P 500 fund. Then there is DSP. A DSP, they are following an active approach. So they have fund managers based out of Bombay who are actively choosing in what stocks to invest, which stocks to pick, what sectors, etc. And they're not just specific to US. They have a good mix of US, Europe, as well as China. So 60% is US, the rest is the remaining markets. So they are country agnostic and invest wherever they see there is a good growth or good stock available to invest. Now, coming to Marcellus, Marcellus is also a completely inactive strategy. Marcellus, in fact, always had a AIF called as Global Compounders portfolio as a category 3 AIF. They've been running it for last couple of years. And the same strategy, whatever they've been running, now they have opened up a retail option. So they again will be investing in stocks across the world. As of today, a majority of the stocks in their portfolio are based in US and Europe. Then comes the Edelweiss Gift City option. Edelweiss are offering a Greater China equity fund. If you are aware, Edelweiss also has a similar fund in their mutual fund format, Edelweiss Greater China Fund. Now, because of the RBI limitations, etc., people cannot invest in a larger amount in that. So, if someone believes that the China story is great and true, and it will be a good opportunity, then exploring Edelweiss Greater China Equity Fund would be a good option. Now, broadly, these 4 are the options that are available in the Gift City, and more will be coming soon. Now, the next part of the section in this webinar, what I'll be doing is I'll be trying to answer some of the commonly asked questions that we have received from the audience, and trying to answer them and post these questions. We can open the floor for discussions for any of the Q&As. So the first question that we usually get is, who will pay the tax? The fund pays or the investor? Like I mentioned earlier, all the taxes will be paid by the fund. Whatever investor gets or whatever investor sees in the NAV is the final value. When you redeem, you get the final value. No tax separately need to be paid anything. Second, is inherent tax or estate tax applicable on investment in these funds? Through Gift City, the scheme is set up in such a way that it is governed by Indian tax laws, and there is no inherent tax or estate tax applicable for resident Indians investing in these schemes. What are the TCS implications for investing in this fund through LRS? The same TCS implications are applicable here also. Up to 10 lakhs, you can invest without any problem. After 10 lakhs, what happens is 20% will be withheld as TCS, and again will be refunded or offset while tax filing. What are the tax rates at fund level? This is important to understand. Like I mentioned earlier, the long-term capital gains and short-term capital gains are based on the tenure. And if it is greater than 24 months, it is one rate, and less than 24 months, it is another rate. Now, if you're aware, in mutual funds or in capital market like stocks in India, the long-term capital gains are 12.5% for greater than 1 year of holding. And in case of less than 1 year of holding, is termed as short-term capital gains and taxed at 20%. But in this case, the numbers are 12.5% and 30%. Now, on top of this, again, there are certain surcharges and cess available. That means a 12.5% post surcharges, assuming that the fund automatically is at a higher tax slab rate, will come down to 14.95%, and short-term capital gains comes down to 42.74%. So to simply explain, let's say someone has invested 100 or let's say 1 lakh in a particular gift retail option, and they held only for 1 year, and that 1 lakh became, for example, 2 lakhs. So out of this 2 lakhs, 1 lakh is the profit or the short-term capital gain. Out of this 2 lakhs, out of this 1 lakh gain, 42% is already uh, paid as the short-term capital gain. So only the remaining amount, 56K, will be available. So that is what the investor would get. If the holding period is more than 2 years, then it would be only 14.95%. So at any given point of time, in each of these, in every of these gift city funds, you will see two NAVs. One is a long-term capital NAV, and second is a short-term capital NAV. Tax return filing in India. This is with respect to the interactive brokers or the brokers, not with respect to the gift. With respect to gift, it is as simple. You just need to declare regularly, because anyhow you would be paying or you'd be getting post-tax returns. Now, I'll spend some time on what is the investment type usually with respect to retail funds. The minimum investment in a gift retail fund is 5,000 US dollars. So roughly that translates to around 4.75 lakhs one time. And after that, you can always top up like an SIP or whenever you feel like topping it up. The minimum amount is $500. The average expense ratios in these funds lie between 0.6 to 1.5%. Obviously, with the index funds, it will be lesser, and with the active funds, the expense ratios will be higher. The next question that we have is, why should one invest in Gift City when buying US stocks directly on a broking app is cheaper? Yes, it is cheaper to book. In fact, I would not say it is in fact cheaper. You will get a similar kind of expense ratios if you were to buy in mutual fund or through gift or through stocks. The reason for buying through gift is that we'll avoid the tax, especially in the wealth or the estate tax, and it will completely shield in terms of the family. If let's say someone were to pass on this fund, so it will be completely shielded, and without any hassle, you can definitely keep and hold it for a longer period of time. And also the compliances would be reduced. Do I need a foreign or USD bank account for Gift City investments? You don't know. You don't have to need any foreign investment bank account. You can invest from your existing Indian bank account to make the payments in the gift retail. Is foreign tax applicable to Gift City investing? No, no foreign tax is applicable. All Indian taxes would be applicable. Does RBI block foreign investing? RBI doesn't have a limitation or a jurisdiction on the IFSC part. So there are no limitations. That is the advantage of investing through GIFT IFSC. At any point of time, RBI won't say income. RBI won't come and say that we are restricting the amount of investments abroad. That is only applicable in the SEBI related parties. In Gift City, SEBI doesn't oversee. It is overseen by IFSC, and hence there will be no blockage of investments. Will the money be locked in? There is no money lock-in. You can always buy and exit at any point of time. Just that the short-term capital gains are a bit higher, and that's why you tend to usually not stay for a shorter period of time. If your investment horizon is longer, then this will be a very good option. Why should one opt for global allocation? Like I mentioned, the diversification, low correlation is one aspect. I also wanted to bring in another aspect, that is the US dollar exposure. Now, all the investments that you buy or you make through Gift City are US dollar denominated. As you all are aware, US dollar is an asset class, or it is a uh, is such that it is consistently compounding or consistently uh, appreciating against the Indian INR. Because of that, you get the advantage of the depreciation. So let me show a quick chart. So if you see the USD versus INR, the USD has been consistently appreciating by roughly 3% year on year. So apart from the regular gains that we get from direct investing, you can add another 3% on top of it. So even if, let's say, the foreign investments that are made to retail investing, retail gift retail options are giving out around 12%. So the depreciation of INR is the kicker on top of these investments. So that is the additional advantage of investing in IFSC or gift options. So let's come to the final part of Q&A. This is it from our side. We'll be happy to take any questions from our viewers. Can we through Zerodha? Right now, there is no option through Zerodha. It is with Gift is entirely different from the current brokers that we have in the SEBI format. So it has to be, you have to open a separate folio in Gift City and invest through them. So uh, we are uh, Gift City enabled in terms of the distribution, so we will be able to help in this regard. Yeah, Ganesh. So we are distributors for some of these products, so we'd be happy to help in investing in these products.
Yet the question is if we have our own product in the city, not yet.
Can this be integrated in small case strategies by any chance? Yes, I think small case is going to enable foreign investing strategies, meaning a brokerage would be there, and we'll be trying to incorporate these strategies in some of our small case strategies. But like I mentioned earlier, right, the onus of tax filing through PINR conversion would be at the hands of the investors. And unless if we have a sizable amount of investments that we want to make, also along with that we have sufficient know-how on the tax filing, then it would be a good proposition. But that also need to be taken into consideration while investing through directly. Does Gift City investment allocation favor the US market, or is there a significant percentage distributed across emerging markets? So, Krishnakant, Parak related strategies are completely US focused. Marcellus and DSP are not just US focused, but are spread across US, Europe, and emerging markets. But because of the virtue of that, majority of the good stocks or companies are domiciled in US, most of these funds, or 60 to 70% of these funds, are allocated in US denominated stocks. And then comes Edelweiss. Edelweiss is purely China focused. It's a China based fund and doesn't invest anywhere else. Do we have any historical CAGR for these global funds? Yeah, definitely. So these are, let me share my screen and present you the CAGR. Now, the funds that we have recommended or we have shown, right, both NASDAQ and S&P 500 are already there in existence. There's nothing new that Parag Parikh is doing actually. It is just being a wrapper in investing in this S&P 500 or NASDAQ. So I'll just share, even the Edelweiss Greater China Fund is also has been there in existence. Only the DSP, their track record is new. In fact, Marcellus Global Compounder Strategy also has been in existence since 2021. So that's the data available. Let me share my screen and present you the numbers for S&P 500 and give me a second. So this is the data for NASDAQ 100's performance. Yeah. Can you see my screen? Is it visible, right? Yeah. So on an average, the 3-year, 5-year, and 10-year rolling returns are these 15, 14, and 13 respectively. And these are rolling returns, by the way, across uh, since 1991. So more than 40 years of data, or 30, 35 years of data. And these are the minimum and maximum 3-year, 5-year, and 10-year rolling returns. If you also want to see the drawdowns, these are the drawdowns with respect to Nifty 50 and Nifty 100. Nifty 50 and Nasdaq 100, if you see, Nasdaq 100 is a more volatile asset class. Actually, that makes it more difficult in terms of choosing direct investing option, because unlike in India where you have SEBI rules of circuit limits, in US markets there are no circuit limits. The stock can rally, go up or go down by 20-30% in a given day if something happens. So that's a high volatile market, and hence an index is a better option than directly investing. And these are the uh, over the last 12 years uh, average 5-year CAGR returns of Nasdaq. They hover around this level of 14%. Yeah. Yeah. Okay. Further moving on. How is Greater China in terms of correlation? In terms of correlation, the Chinese correlation, if we were to see, has been decreasing. Now it is at the lowest because of, let me quickly share. Okay. This is with respect to, if you see Hong Kong or Hang Seng close proxy with respect to the Indian equity markets, it is somewhere between zero point 0.4 to zero point 0.5. That is, if I take the average of the last 20-30 years. But if you take rolling returns, notice the Hang Seng, which is the green color. The green colored one since 2008 has been pretty high, meaning it is highly correlated with the Indian markets. But off late, the journey or the trajectory has been negative or diverging quite a bit from the Indian markets. Now it is standing somewhere close to 0.2. So that is with respect to the China markets. Yeah. Is there a recommended combination of these funds, including India funds, where better optimized CAGR, max drawdown, and time duration? Yes, Shekhar, we have certain baskets curated on these lines. We can discuss it offline, where we know, I mean, we can suggest right recommendations of these combinations. These are usually provided for our clients to invest, but what we do is we have some proportions. Earlier, these proportions were not able to be met because of the limitations on mutual fund side. Now that we have the gift option, we are now opening or recommending through a combination of mutual funds plus gift to ensure that these are met.
Free to drop any email if you have further questions at research@factlab.in. I'm just typing that out. Yeah. Thanks, everyone.
Thank you. Have a nice day. Bye bye.